Finances. Understanding your co-op's finances are as important to cooperatives as they are to any other business. At the same time, it is important to remember that cooperatives are different. Cooperatives are based on the values of self-help, self-responsibility, democracy, equality, equity, and solidarity. To uphold these values, cooperative members operate in ways that embrace honesty, openness, social responsibility, and caring for others. Let's spend some time exploring how cooperatives carefully monitor and support profitability while remaining true to their values. Long-term financial planning, maintaining reserves for a rainy day, and keeping good financial records are essential for successful operation. Let's take a look at how these common sense practices can help a group of pizza entrepreneurs that just opened Cornerstone Pizza Co-op to do what they do best: make delicious pizza pies. Cornerstone Pizza Co-op is well prepared because they have a sound business and financial plan that was developed prior to opening. They are ready for the future because they maintain reserves to draw on in tough times. Their long-term financial plan includes income goals as well as anticipated long-term expenses. The long-term plan is created through discussion and consideration of varying perspectives, then finalized by a vote of the board of directors or the full membership. Preparing an annual budget helps them run a tight operation by tracking expenses while controlling spending. They pay special attention to bookkeeping and preparing monthly financial statements. Finally, they recognize the value of integrating transparency into all of their financial matters. This keeps everyone on the same page and promotes trust. Carefully prepared financial statements are shared with members each month so that they can track the financial progress of their new, awesome pizza cooperative. Let's take a close look at two important financial reports: the income statement and the balance sheet. The income statement, also called the profit and loss, shows the business performance over a period of time. Resets at the beginning of the co-op's established fiscal year, which is often January, but can be a different month. Summarizes all revenue, which is the amount a co-op receives from selling goods or services, and all expenses generated by the business. Determines the net profit or loss, or the bottom line, which is calculated by taking your total revenue and subtracting the sum of all your expenses. Allows members to compare income from catering services versus pizza slices, as well as expenses such as ingredients, utilities, and rent. The balance sheet shows the financial position of the co-op business as of a particular date, such as the last day of the previous month. The assets: cash, accounts receivable, inventory, land, buildings, equipment, and other things the co-op owns. The liabilities: loan amounts, accounts payable, which includes unpaid bills and taxes and other debts the co-op owes. And equity: the amount of money that remains after all debt and other liabilities have been paid. Let's dive even deeper. The income or profit and loss statement for Cornerstone Pizza reports the results of business transactions during a particular period of time, in this case in December, the last month of the co-op's year. Notice that the report shows all of the income, both for the month as well as year to date. This is referred to as actual because it is what occurred during that period of time. The report also includes a column for the budget, which is the estimate that was made at the beginning of the year. This helps the board and members track how the co-op is doing compared to what they had planned. Cornerstone Pizza Co-op made $12,140 this year. Notice that the budget anticipated is $21,000 in income. So the co-op made a profit, but not as much as they expected. Can you see the largest source of revenue for the cooperative? How close was this to the budget? The largest source of revenue was from the sale of whole pies. Note that they actually earned more from the sale of whole pies than they anticipated. Now, can you see how much money the co-op has in the bank? You cannot find it because it isn't on the income statement. We need to look at the balance sheet for that information. The balance sheet provides details on what the co-op owns, what it owes, and what remains. Basically, the co-op's financial condition. Note that the balance sheet answers our question about how much it has in the bank. It shows each bank account and the amount in them on the day the report was created. The co-op has two bank accounts, a checking account with $8,000 and a savings account that includes $60,000. The accounts are part of the co-op's assets, all of the resources that are owned by the cooperative. It also shows all of the liabilities, which include all of the debts or obligations that the cooperative owes. Let's take a closer look at how this breaks out in the balance sheet. Notice that assets are what the cooperative owns in cash and things that could be sold to bring in cash. Again, amounts shown in the bank account, as well as inventory, prepaid expenses, and petty cash the cooperative has. Prepaid expenses for the co-op is the amount they paid in advance for their insurance. These types of assets are all current assets because they are cash-based or can be readily converted to cash. Another form of asset is a fixed asset, such as a delivery van or equipment owned by the co-op. These are assets that cannot be readily used because the co-op would need to sell them in order to get cash. Liabilities are what the co-op owes. Similar to assets, liabilities are also broken into two parts. First, current liabilities includes amounts owed at the time the report was generated. It also shows $5,000 in accounts payable, which include bills that the co-op has received but that aren't yet paid at the time the statement was generated. Below this is a category called long-term liabilities. This shows that the co-op has a loan of $40,000 taken out to purchase the delivery van. They also had a startup loan for $88,500. These amounts aren't immediately due, but they are amounts the co-op ultimately owes. Equity is the net worth of the cooperative business. It is equal to the co-op's total assets minus the total liability. Another way of looking at this is that the sum of the total liabilities and equity is equal to the assets. Notice that it shows the $15,000 in retained patronage. Recall that patronage is the way that cooperatives distribute profit among members. The retained patronage includes amounts that are being held or allocated for specific members. Equity also includes $43,000 in reserves. The reserves in a co-op are often called retained earnings, which includes a portion of the cooperative's profits that are set aside for the co-op to use. One way to quickly test whether your balance sheet is indeed balanced is to see whether the amount listed for total assets is the same as the amount listed for the sum of liability and equity. The co-op shows $208,140 in total liabilities and equity and $208,140 in assets. As you can see, the co-op's liability and equity match, so it is balanced. If the liability and equity do not match, there is a mistake, such as incorrect or misplaced data, miscalculations, or other problems. If this is the case, you should review it carefully to identify the error or ask the bookkeeper to find the problem. The financial documents may seem daunting or confusing at first, but trust me, they are your friends when it comes to keeping your co-op on track to financial success. In the end, it's just good common sense. Planning and budgeting keeps the pizza pies coming during good times and during rainy days. Prepping and sharing your monthly or bi-monthly financial statements with all members keeps your co-op transparent and promotes trust. And reviewing statements with your co-op board and members keeps everyone informed so they can make wise decisions about their shared future.